Okay, here we're going to be looking at a choice of interest rate, and we're going to also include the fair value option here. And we're going to be looking at a notes receivable exchange for, in this case, it could be for property, goods, or services. And for our example here, it's going to be for services here, where Corporation A performed consulting services for Corporation B in exchange for a 2-year zero interest bearing note having a maturity value here of $150,000. Now Corporation A pays 6% interest for money that they borrow here, while Corporation B, with their credit rating, they require an interest rate here of 10%, or Corporation B has to pay a 10% interest rate based on their credit rating for money they borrowed. So the question here is, what interest rate would be used here for discounting this note? Either at 6%, 10%, or the market rate of interest. Now, remember, Corporation B is issuing this note here, and their interest rate here required is 10%. So let's go look at our rules here for the choice of interest rates here. So a note received in exchange for property, goods, or services based on an arm's length transaction. You must determine the fair value exchanged here and its present value based on the applicable interest rate, or the imputed interest rate in this case. For the issuer of the note, use the issuer's interest rate based on their credit rating. So in this case, Corporation B is going to issue this note here, and their credit rating is interest rate here is 10%. So we could just go in and do our present value function here. We're taking a $150,000 note, discounting it back here for 2 years at 10% at the beginning of the year here, gives us a present value of this principal on this note here at $123,966. So we can just look at our a cash flow here. Let's just say we're going to do an internal rate of return calculation here to confirm that present value. So we got the present value of the note received here. We determine it to be $123,966, and then the face amount of the note here in 2 years at its maturity, in 2 years into the future year, is $150,000. So plugging that into your computer, we can confirm that that present value of 10% equals the internal rate of return here of 10%. Now just looking at the discount in this notes receivable, the $150,000 face amount here less its present value here of $123,966 gives us a discount that we have to amortize at $26,034. So using this effective interest rate method here, we set up our discount amortization schedule here, where we have a zero interest payment on this note. So we don't get any cash received on this note. So it's a zero interest payment note. So we start out with our amortized amount here of $123,966, and we have to amortize it up here to $150,000. Its maturity value here, the $123,966 is its present value. So just taking our 10% interest rate here times the beginning balance, $123,966, you get your interest revenue for end of year 1 here at $12,396, and the discount amortization would equals the interest revenue here. So add that to the beginning balance here, $123,966, and you get $136,362. And you just continue using this 10% method here for your interest amortization. And you'd amortize it up here to $150,000. So next we'll look at how we'd record this note here, and then also how we'd use the fair value option in the case that the value of this note here changes. Okay, now let's look at how we record this notes receivable with and without this fair value option. So let's start out without the fair value option, and this would be our normal way of recording this notes receivable. So upon the notes receivable, we debit it here for $150,000, and then we'd go and we'd credit our revenue account here on our income statement for $123,966. And that's simply the difference between the face amount here of $150,000 less the discount here in this notes receivable of $26,034. And then each year we'd recognize interest revenue by the amount that we calculated off our amortization schedule. We'd credit that here by that amount, and then we'd reduce our discount here on the notes receivable by that amortization amount. And then when the note becomes mature here, we'd credit out or reduce our notes receivable by $150,000, and then we debit or increase our cash account here for $150,000. So now let's go over and look at how we'd record this notes receivable with the fair value option here. And of course, our fair value option, this is where the receivables are recorded at their fair value, with the unrealized holding gains or losses reported as part of net income. So for example here, we're going to convert to the fair value option here on this notes receivable based on the end of year 1 here. So what we have to do here, we have to determine our book value or carrying value here at the end of year 1, and then we have to determine what our fair value here on this note here is at the end of year 1. And the fair value on this note here, we're going to use $160,000 here, and that would be based on some new interest rate here in this notes receivable. So let's go and determine what our book value or carrying value here is at the end of year 1. Now we could take this all off our amortization schedule. We want to go through the mechanics here to show how we'd go through our numbers here to determine these values. So we'd have to determine the notes receivable at the beginning of the year 1, its carrying value here, and that we determined to be $123,966, and that's simply the difference between its face value $150,000 less the discount we have on this notes receivable. That gives us our notes receivable the beginning of year 1, its carrying value or its present value in this case. And then we have to have our amortization here for year 1, and that was $12,396. That came off our amortization schedule again. So adding those two values together, we get the book value or the carrying value here at the end of year 1 to be $136,362. So we take the fair value that we have here of $160,000 and compare it with our book value or carrying value here at the end of year 1 of $136,362. So you can see we had an increase here. So in this case, the difference was $23,368, and that is recognized here as an unrealized gain here at the end of year 1. Now this unrealized holding gain is really the difference between the fair value and the carrying amount here at the end of year 1 in this case, or if you're comparing periods, we have to match them up here for periods. So how would we record this here? So for our unrealized gain here, for our notes receivable, we debit it for the $23,368 here, and then moving over to our income statement here, we have an unrealized gain in this case here. We credit that here for $23,368. So that takes care of converting over here to the fair value option here at the end of year 1. But now we'll have to look at, and we're going to have to carry this fair value option through here. So if we elect using the fair value option, we must continue use of this fair value option measurement until the financial instrument is no longer owned, or it's received in this case. So let's look at the case here where we had the fair value at the end of year 2 to be $140,000, and again that's based on some new interest rate that we came up with to determine this fair value here. So we compare the fair value here at the end of year 2, $140,000, to the $160,000 fair value here at the end of year 1, or its carrying amount here at its fair value. So you can see we have a decrease here of $20,000. So in this case, we have an unrealized loss here at the end of year 2. So how do we record that here? We credit or reduce our notes receivable here by $20,000, and then we would recognize that a loss here as an unrealized loss here on our net income statement, or we debit here our realized gain here for $20,000. So in summary here, when we're converting over to this fair value option, we have to determine what the book value here is at the date that we're converting to the fair value. And all we're doing here is then we compare our book value or our carrying amount here at that particular time to the fair value at that particular time, and that'll give us our unrealized gain or loss. And then we would recognize that or record it here as our notes receivable, either a gain on our notes receivable or a loss on our notes receivable. And then we have to recognize an unrealized gain here on the income statement, and that stays as an unrealized gain until the notes, in this case the notes receivable, is disposed of, and then we would realize any gain or loss here that we had calculated.